Hi, and welcome to the Macro Show. We talk macro and trying to make sense of markets that, well, obviously didn't make any sense today. I mean, come on. Stock price is flat. Bond price is down. That's ridiculous. Hey, we got gold. We got to talk gold. I know some of you are saying, when are you going to talk about gold again? Oh, today we're going to talk a lot about gold because gold is speaking to us. It's telling us something. We can hear it out in the kingdom. And what is it telling us about financial conditions? What is it telling us about interest rates and where equity prices are going and real yields? All that stuff, we're going to get into that today. We've got a slew of economic data because obviously there will be no economic data tomorrow. And due to a shortened day on Friday, there will also not be any economic data, although there will be the H.8. And yes, I will be here because the H.8 requires me to be here for that. So we've got all kinds of stuff to look at. Let's get right into this. Yes, I forgot. We got to talk about, there's some questions in the comments about this quarter end selling. And some people didn't understand that. Is it the bank selling? Is it the Fed selling? No. It's money managers. So pension funds, large institutional money managers. For example, if you own a target date fund in your employer sponsored plan or one of those blended portfolios of stocks and bonds. Now, in the investment policy statement, now all of these funds have rules that they have to follow. The money managers say when they designed it and said, this is what we're going to do. Somewhere in there, it says every month or every quarter or whatever their interval is, they have to reset the portfolio back. So if stocks are going up, where's my arrow, right? And bond prices are going down, then they have to readjust the portfolio back to whatever percentages it needs to be. Now, if it's going the other direction and we have interest rates going down, and I know stocks never go, so that doesn't, it's the wrong color. But if interest rates are going down and bond prices are going up and stocks go down, they have to go the reverse. They have to sell bonds to buy stocks. Now, some people said, well, 300 billion isn't a lot. Well, it would be the fourth largest in history, so it is a lot. Now, to the equity market, 300 billion isn't a lot. But think about it from the bond market perspective. The Fed's buying 120 billion a month. The primary dealers, based on my data, are marginally keeping up with that. I mean, in most months, they're not. So you're going to have 2.5 times what the Fed is buying in a month per month in December. Now, these are estimates, so when JP Morgan and all these other banks come out, they're estimates. Now, why are they estimates? Because the quarter end's not here yet. We got a whole month to go. Now, if you are a large pension fund or a large institutional money manager, you don't make these moves in 1 day or 2 days. You got to do it over the course of several weeks. But if stocks were to crash 10%, in the first, say week or two of December. And I know somebody like that, it's not going to happen. Look, I know you're probably thinking like, hey, it's good you're working on your stand-up routine for when this doesn't work out and you're totally wrong and you get, chased away from the industry. Right, exactly. If stocks were to come way back down, that estimate comes down too. Or if bonds were, I know. Yeah, I know. See? Yeah. See, I know some of you are like, oh, he's finally getting it. No, I'm seriously though. If bonds were to rally or stocks were to come down and close that gap, that estimate falls. That's how it works. So all these banks are doing is just saying, look, this is what is, if nothing changes between now and, through December, this is what's going to happen for all of these funds to get back to where they need to be. Now, insiders have been selling while retail is buying. I find that pretty interesting that retail investors, I see the comments, tweets, emails, look at all this. It's so easy to make money in the market. It only goes up. Except insiders are selling while you're buying. Keep that in mind. Another issue, this is today because I know the dollar bears are having a lot of fun today. And I salute you today, dollar bears. Dollar's going in your favor. Still not near the 5-year lows though. So don't count your chickens before they hatch on that. But think about this. What did we hear? Like 13 million people are going to lose their pandemic unemployment assistance at the end of December. They're going to have less income. That means less dollars. And what did we also learn? That some people are going to have to start making rents because evictions are starting. Some sent me an email, said, hey, they're already starting where I'm at. So people that haven't been paying rent are going to need to find somewhere to live or start paying rent. Homeowners that have not been paying their mortgage, some of them are going to have to start paying that. And people that have Student loans are going to have to start paying them in January. What does it mean when you need to pay something? You need dollars. So there's the dollar demand. So part of the reason we have seen this weakness in the dollar has nothing to do with QE or fiscal, because QE doesn't print money and fiscal just shifts money from someone who has it to someone who doesn't. So no net money creation. What it tells you is, as all of these things start to work themselves through the system where people have to start paying on their bills and they have less income, they have a demand or a need for dollars. So there you go. So don't count the dollar out just yet. All right, let's get into the economic data. We got, like I said, a slew of it to go through, so we're not going to go in as detailed as we normally do to keep the show at a reasonable time, even though maybe you have an extra day to watch now. Redbook retail sales, not adjusted for inflation, went up 2.8%. This is still fairly low for same-store brick-and-mortar retail sales. Take off the consumer price index at 1.2, and you're looking at an anemic, 1.6% year-over-year increase adjusted for inflation. Not a big deal. Housing prices continue to rise 9.1% over last year, and some people say, well, this is inflation. Part of how things work is when you think about fiscal. So what is fiscal doing? Again, it takes money from someone who has it and repositions it. So if money that's not being used is being put in the hands of people that are using it, and they choose to put it in, say, stocks or real estate, you will see isolated pockets of inflation that literally eventually turn into a bubble, which they are now. So don't think that this is sustainable. These housing prices are sustainable. And I know many of you are, young and are looking to buy your first home, and you just keep shaking your heads. Prices, are they ever going to stop going up? They will when the buyers stop buying. Because if you couldn't afford a house last year, you couldn't afford it 2 years ago, you certainly can't afford it now, and you're probably not going to be able to afford it in 6 months if prices are at this current level. But eventually, all the people that can afford houses at this price, they'll go away because they're all bought. And that's when bubbles burst. It's the same true of stock bubbles, tulip bubbles, all kinds of bubbles. When the buying stops, when the music stops, the bubble pops. Let's take a look at the Richmond Fed Manufacturing Index, still in expansion, but at a lower rate. Everyone talking about this massive recovery, and all we're seeing across all the Fed data is less growth. That is not conducive of a booming economy. 7-year auction, surprisingly well. Still, market sold off on that. Bond prices went down. Everybody thinks there's inflation's coming, but the data didn't confirm it. So here we have mortgage applications up 3.9% as rates sitting again at record low, 2.92 on the 30-year. Crazy. I still think they get down to like around 1.5 when yields hit zero or close to that. We'll see how that plays out. Durable goods new orders up 1.3% on a year-over-year basis, still negative. They don't have the year-over-year number here, minus 1.1, I believe. This is the Dark Metra index that Chris Dark and I worked on, mostly his work, but this is meant to figure out the consumer, where the consumer is at. This is durable goods excluding defense and excluding non-defense aircraft and parts. Presumably, most people who watch the show probably do not own an airplane or in the market to buy one. I've charted against the average weekly hours of production in non-supervisory employees, and what you notice is that demand for goods has a lot to do with what people make. I know, staggering, isn't it? But you can see that these are both slowing down. The momentum is slowing down. So the question is, will weekly hours production and non-supervisory employees continue, or will they slow down and roll over like we're seeing in some other economic data? If that's the case, then you can expect the demand for durable goods to also roll over with that. Moving into some of the other data, we've got PCE, personal consumption expenditures. There's the core. Where is the PCE? That's third quarter. There's so much data being dumped. Here we go. PCE price index flat. What? I thought prices only went up 0%, or flat over last month, and the year-over-year rate of change went from 1.4 to 1.2, mimicking effectively what we saw with the consumer price index, the bogus consumer price index, according to fans of this show. There you see the two of them together are showing the same thing, and we'll zoom this across. They're both rolling over. Wait a minute, I thought this should only be going up. That's what everyone's talking about is, well, the CPI and the PCE, they have to follow the M2 up. Well, they're not. In fact, they're rolling over, suggesting that this is actually disinflationary, suggesting that I believe they will continue to head lower and eventually go into contraction, just like they did in the great financial crisis. Moving along, what else do we have in here of interest? Unemployment claims. Like I said, there's a lot of data being dumped today because of the Thanksgiving holiday. Initial jobless claims rose to 778,000. Almost not a surprise, considering that states entered new restrictions and lockdowns last week. So I expected this number to go up. The market thought it was going to go down. But the real number is all persons claiming unemployment benefits in all programs rose 135,000 to 20,452. Keep in mind, these people on the pandemic benefits going away at the end of the year. That's not good. Not going to be good, especially if you're looking for a weaker dollar or an increase in durable goods new orders. That's not going to be good. All right, what else do we have in here that we're missing? Let's see. Consumer confidence from University of Michigan. We have consumer sentiment fell. Now, this is not what you want to see in terms of where stock prices go, because what happens is usually stock prices follow what consumers believe. And if you pull this chart back, you can see that consumer confidence is falling, and yet stocks are somewhere way up, pretty high. If we could overlay stocks in here, and I don't believe we can, they're way up here. Consumer confidence is down there. Not what you're really looking for. Current sentiment is down, or consumer sentiment, that's what we just talked about. Current conditions are up slightly, but they're not very optimistic. Consumer expectations are falling. So what consumers are now thinking forward, December, January, they're thinking things are going to get worse. Not good for stocks. Inflation expectations rose, probably due to everyone talking about it, but not due to actual inflation expectations in the data. I expect that will change. New home sales in October continue to be strong as continues to be a demand for housing. Let's take a look. What else we have here? Crude oil. You see inventories fell. Keep in mind, I don't think crude oil, well, I'll show you why. Today is a banner day. We're looking at crude, gold, stocks, bonds. I mean, the works. And when you understand how all this works, what is higher crude oil? So if we said, okay, crude oil is rising, what does it mean for financial conditions? Are they getting tighter or looser? What do they mean? If you guessed looser, you'd have it right. So higher crude oil effectively tells you financial conditions are loosening. So falling crude oil tells you financial conditions are tightening. And that's why, or one of the reasons why I'm bearish on crude, because financial conditions aren't easing. And yet the market is trying to front run this perceived demand that's coming. And, they believe that should Joe Biden become president. I know there's views on both sides, so we're just going to leave it as should he become president. They believe that his policies are going to drive crude oil prices higher. But here's the problem. They have to be met with demand. That is the ultimate issue. You can drive prices up, but there's a point where people will stop. When you have 13 million people that are about to have less income at the end of December and have to start paying more bills that they're not paying now, they're not going to be like, man, that's great. I can't wait to pay all this money for gas and all this other stuff. That is why when there is a dollar shortage or financial conditions are tight, that higher prices are ultimately rejected. Speculators can move them up. They're front running this, but I don't think they last. Let's take a look at, and that's, gasoline inventories went up last week. That, market was absolutely not expecting that. It'll be interesting to see how it is this week. because of the holiday week. And then we have the FOMC minutes. Yes, let's talk about the FOMC minutes. These are always a month old. Now, what's interesting about these is the Fed actually tweaks them a little bit. They have their minutes, and then they see how the market reacted to the press conference, and then they adjust the minutes to smooth all that out when they come out a month later. So here we have, let's talk about QE, response to the desk survey. Generally expected the Federal Reserve purchases of Treasury securities and agency mortgage-backed securities to continue at the current pace. That's $120 billion a month, my friends, through the end of 2021. Now, they thought that it would slow down, fat chance, but we'll give the Fed some credit for at least acting like things are going to improve enough. They're going to slow their purchases in 2022 to 2023 with the expectation that they're going to raise rates in 2024 so they can keep buying bonds. Now, there were some questions that came up on Twitter, and let's see if we can find that where that is. Okay. Here we go. Participants noted that the committee could provide more accommodation if appropriate, increasing the pace of purchases. Oh, no, that's not what I wanted. We'll get back to that. Let's see. In their discussion, participants focused on the objectives of these purchases. So now they're discussing, are we meeting our objectives? Considerations for assessing the appropriate pace and composition. So they're trying to decide, is QE working? Is it the right pace? Composition of asset purchases over time. Communication, which is more important because that does more than anything. Jawboning, the future path of asset purchases and the potential effect of higher levels of reserves at the banks associated with the ongoing expansion in Federal Reserve asset holdings on banks' balance sheets and money market rates. Participants agreed that this discussion would be helpful in the future assessment of the appropriate structure of the committee's asset purchases. Whoa, wait a minute. Maybe there's a change in the asset purchases? Aha. That's what we come down here. Participants noted that they could provide more accommodation if appropriate by increasing the pace of purchases by shifting its Treasury purposes to those with a longer maturity. Yes, so they discussed perhaps buying more 30-year bonds without increasing the size of purchases. Didn't I tell you that was coming? I know. I get one thing right, so we'll give it to me there. I did say that could happen, and you hear this is coming from the banks. Remember, they're on the opposite end of this massive 30-year speculative short position. Of course they're going to want that. Alternative, the committee could provide more accommodation if appropriate by conducting purchases of the same pace and composition over a longer horizon. So they even discussed that we could go past 2021. So effectively, the key here is no change in asset purchases. Now, stock market is extremely overvalued. Now, some people like buying stocks at high prices, and that's fine with me. Not what I like to do, but here's the Wilshire 5000, only because Fred database doesn't really have the historics on the Dow or the S&P. So we use the Wilshire 5000, which is all U.S. stocks. So going way back, divided by the gross domestic product. So effectively what you're looking at is price of stocks based on economic output. And here is the bubble at the peak of the dot-com era. Here is the great financial crisis peak. And here's now, where everyone says, great time to buy. Now, what is the market telling us? Is stock investors believe that corporate earnings and profits are going to go way up. And if they're wrong, well, that means stocks eventually are going to go way down. So you pick which one you think it is. We know what the market thinks because we know how they're invested. It's very obvious. But people are cool with buying stuff that's really, really high. All right, now let's get into gold, because I've been really wanting to talk about gold, and I know we burned up a lot of time on the clock. But since it's a holiday, maybe you have a little extra time to watch. So what is gold telling us about financial conditions? And this is really important. I want you to think about this. When gold is rising, what does it tell you about financial conditions? Are they getting tighter or are they getting looser? If you guessed looser, you got it. Right? I mean, think about it. Why does that make sense? Because when do people buy gold? When they have money, right? I mean, one of my clients, she used to work at a jewelry store. When money was flowing, people came in and buying gold watches and jewelry and all kinds of stuff. No problem. Unfortunately, doesn't have a job right now. gives you a state of that kind of economy locally where I'm at. So falling gold prices mean financial conditions are tight because people don't have the money to buy gold. It's telling you something, it's speaking to you. Now, if we look at this, it also tells us a lot of important things about, say, consumer prices. I know most of you think it's bogus, but we got to work with what we got to work with. It tells us a lot about real yields. Just so you know, whenever you hear the word real, it's inflation adjusted. So there's a difference between yields and real yields. There's one that is just what it is, and the other is adjusted for inflation. So, be very clear. I'm talking about real yields or inflation adjusted yields. Let's first look at gold relative to the consumer price index. And what you see, with the exception of the dot-com bubble, because gold was already fairly depressed at that point, is gold tends to start to fall. You see, I made it in orange because it stands out a little bit better. You see, gold tends to fall, and it doesn't always lead, but it generally leads the consumer price index in blue, which is shown on a year-over-year rate of change, lower. It's telling you something. See, it's speaking. You got to listen to the market. We got to stand up in the kingdom sometimes, my friends. We got to listen to what we can hear out there. We see Sorcerer JP running around doing his QE spell, but we got to listen to what our allies are saying. And right now, gold is telling us, hey, the consumer price index is probably headed lower. What? That's crazy talk. But you can see it right here in the data. I know some of you complain about me moving the mouse around, so there. I will try to stop moving around, but you can see it in the data that when gold tends to fall, and you can see it right here, gold down, consumer price index down, gold up, consumer price index up. You can see here's a trend, gold rising, consumer price index rising, gold fell. And you say, well, wait a minute, but then the gold started rising. Why didn't it follow there in the great financial crisis? And that is because then we need to discuss the dollar. So what happens here is gold, when it falls, starts to put upward pressure on the dollar. What? There's no way it can't happen. That's how it works, right? Because gold and dollar are largely inversely correlated. Not always, not perfectly, but largely. So falling gold puts upward pressure on the dollar. And if you have further upside on the dollar, so you think of it like a relay race, gold is handing off to the dollar and they're taking off. A rising dollar, as we've talked about, does what for consumer prices? If you guessed lower, you got it right. And so here you have a chart of the dollar. Now, notice the dollar picks up here in March of 2008 and starts to rally. The consumer price index takes it down. But where in March of 2008, let's see, gold bottoms in October of 08, peaks. Trying to see if I can get lined up. There it is, February 08. So what you have is gold starts to lead this move down. The dollar, after everyone thought it was left for dead, finally bottoms and takes off. And here we have again the consumer price index in blue. And it tells us, whoops, we got to move this over a little bit, that the consumer price index is likely to head lower. Now the dollar can go down a bit more and still be okay, because gold is telling you where things are going. This is, for those of you who make fun of my thesis, this is actually really good news. Now we got to talk about real yield. Again, inflation adjusted yields. How do you calculate this? How will I do it here? You take the 10-year Treasury yield and subtract, or any Treasury yield you wish, subtract the year-over-year rate of change of the CPI. And then you get the relationship between real yields and gold, which is largely inverse. Not perfectly inverse, but largely. Now, I'm going to show you why real yields are going to fall due to consumer price index falling. Now, there's a lot of people out there that you will hear them say real yields are going to rise because interest rates, yields are going to rise faster than the consumer price index. No, I just showed you that gold is telling you otherwise. Gold is the key evidence here that tells you that's not how it's going to go. The probabilities favor that yield, even if I'm right, and I will be, that will go down, the consumer price index will go down more, faster, And that will cause real yields to rise just like it did here during the great financial crisis, in which we've seen this chart before. And so here you can see gold going down, and there's a little lag between it and real yields rising, and then they take off. But you can see gold goes down, real yields eventually start to go up, and that is a problem for the market. So what gold is telling us, see, because we get the CPI once a month. That's it. It's once a month. Whether you like it or not, it doesn't matter. That's what we get. That's what the market looks at, what the market cares about. We get PCE once a month. Whether you agree it's accurate or not, if you just stick with whatever it is, it tells you what you need to know. But what gold is telling us right now is real yields are going to rise. Again, the market thinks that this means interest rates are going to rise faster than CPI. They're wrong. I just showed you that. Now, this is where it gets interesting to me, because if we look at what is going to happen with the equity market when real yields rise, so I have the Wilshire 5000 here, and if you look, you see when real yields rise, stocks go down. And you see it during the dot-com bubble. Real yields take off, stocks go down. Here you see in the great financial crisis, real yields go up, stocks go down. And here we have now real yields threatening to go higher because gold is telling us that that's what is about to happen. And yet you have everyone crammed into stocks as if they can never, ever go down again in their life. Very interesting. How about compared to crude oil? Now, you've heard me be bearish on crude oil, right? Look what happens when real yields rise. Back in the dot-com bubble, they crashed. Or not, that's not the dot-com bubble. This is the 1990 bubble, the recession. Now we have the dot-com bubble. Real yields rise. Oil prices went down. Here's that big rise in oil prices going into the great financial crisis. And then real yields rose and literally just took a wrecking ball to them. And now real yields are threatening to go higher, and everybody thinks crude is going to go up. Nope. That's why I'm bearish on crude. That's why I think crude is going to be really, really cheap. How about so let's chart the 10-year Treasury against gold. Is this a valid view? Well, yeah, it absolutely is, because you can see that during periods such as we are now, where gold is pulling back, right, yields go down. And yes, you can see gold rallies up here, push upward pressure on yield, and then gold goes down, yields go down. It's telling us that financial conditions, and here you can see it here, gold goes down, yields go down. It's telling us, gold is telling us that, look, financial conditions are tightening. So you have, banks tightening lending standards. Anyone who says lending is going to come screaming out of the box here in the next month or two is pretty much missing the boat on the 20 million people that are unemployed, and 13 million of them are going to have less benefits, and then people are going to have to start making payments on stuff. Banks know that. That's not going to lead to banks wanting to lend money. You have interest rates that are low, telling you that financial conditions are tight. You have now gold falling, telling you that financial conditions are tightening. And yet people still believe that rates are going to rise. And yet here you have the largest net speculative position in the history, short position in the history of the 30-year bond. And people think that this isn't enough. That yes, rates are still going to rise. And yet despite all of that, despite all of this selling that's hammered the bond market, interest rates are a little over 1.6%. They're not where they're March highs. They're not back where they were in November of last year or even November of the year before. They're not there because the setup is telling you the next direction for yields is down when you understand what gold is telling you. My friends, this is what I want you to understand. A lot of people don't get macro. And I know this show's long, but a lot of people say, hey, I don't, your thesis and la is all wrong. Look, here's the deal. When you've gone through two recessions, and many of you watching the show have, you know that. You've been through them. And you've lost a lot of money. The notion that there isn't going to, that is never going to happen again because we're doing QE and fiscal or whatever crazy things the Fed comes up with is erroneous. It's not, there's no facts behind that. There's no data to suggest that. But when you understand that real yields are going to scream higher and it's going to create a deflationary crash, or as Raoul Pal of Real Vision says, an insolvency event, same thing, same words, you're not going to be able to get out of the equity market. And those who have been through that and have lost money don't want to go through it again because now they've accumulated more wealth. And they know that losing half that is not good. And they know the probabilities of happening again are high. And they know in a computer traded market, which this is, that's massively overvalued, is going to send stocks down faster than they've ever gone before when this whole system breaks apart. And gold is telling you that. Go look at a chart between gold and stock prices and tell me that gold does not indicate that lower stock prices are likely to come. Because when this race is over, my friends, and it will end, this isn't like the tortoise and the hare where the tortoise wins and the hare eventually crosses the line. This is a race where a few people will be at the finish line and most people will never get to the end because they'll lose so much money. That's macro. It's having the patience to wait it out and get to the end. For those of you celebrating Thanksgiving, I hope you have a wonderful time, or Friendsgiving, or whatever it is you're doing. I hope you have a wonderful holiday tomorrow. I'll see you on Friday. We'll get through the H.8. There'll be no economic data. I'll look forward to seeing your comments, but take some time. Think about what's going on here. Gold is telling us a message. And in this kingdom, we listen. I'm Steve Van Meter. Thanks for watching. And once again, unprepared for the content of this video is provides educational information only, is not intended to provide investment or other advice. It is not to be construed as organization, solicitation by a security, financial instrument, or participate in a particular trading strategy. This video was prepared by Steve Van Meter, person, passive business, present video, and do not for the view of Atlas Financial Fighting or Steve Van Meter Financial.